Gold just received the kind of economic data that should have knocked it lower. It barely moved. U.S. jobs came in stronger than expected. Manufacturing surged, and under normal circumstances, that should make life difficult for gold. Instead, buyers defended $4,500. Gold broke yesterday's high, and it pushed all the way to around $4,544. Remember, this is happening after gold has already rallied more than $200 from its recent low, and yet the market still refuses to give much of it back. That is the story today, because yesterday, gold was fighting to get above $4,500. Today, $4,500 is underneath the market. Something has changed, and if buyers can repeat the same thing at the next major level, $4,600 could suddenly come into play. This is grand markets. Here's what the market is telling us right now. Let's start with last night's U.S. data. Initial jobless claims came in at 206,000, slightly below expectations. Then the Philadelphia Fed Manufacturing Index jumped to 47.4. That's strong, and that's usually the kind of number that screams economic overheating. Employment is holding up. Manufacturing surprised sharply to the upside. Anormaji. The market would read that in a fairly straightforward way. The economy is still resilient. The Fed has less reason to rush. Treasury yields can remain supported, and gold should feel the pressure. But that's not what happened. Gold dipped, and buyers came straight back in. It never seriously surrendered $4,500. Then it broke higher again. That reaction may be more important than the economic data itself, because strong markets don't just rally on good news. The really interesting moment comes when they refuse to fall on bad news. And that's exactly what gold is doing right now. Now look at what has happened to $4,500. Yesterday, this was the battle. Gold had to reclaim it before buyers could even think about challenging the previous high. Today, that battle has already moved on. Gold is spending most of its time above $4,500. Pullbacks towards that area are finding buyers, and the previous high has already been taken out. In other words, yesterday's ceiling is starting to behave like today's floor. That is a major change in market structure. It suggests the market isn't simply experiencing one violent rebound. It may be trying to establish an entirely higher trading range, and that's why the lack of a deeper pullback matters so much. Gold has now traveled from roughly $4,325 to $4,544. That's more than $200. After a move like that, profit-taking would be completely normal. A technical correction would be completely normal. In fact, the 1-hour RSI is already in overbought territory. So yes, this market is stretched. But stretched does not automatically mean finished. And this is where traders often make the mistake of focusing on the wrong question. The question isn't, will gold pull back? Eventually, it probably will. The better question is, what happens when it does? Do buyers disappear and allow a deeper correction? Or do they step back and almost immediately? So far, the answer has been very clear. Buyers aren't waiting for much of a discount, and sellers haven't been able to force one. That brings us to the next battle. $4,550. You don't need to remember 10 different numbers. This is the one that matters next. If gold struggles around $4,550, then some consolidation would make perfect sense. But if buyers push through $4,550 and the market starts accepting prices above it, the conversation changes again. Then the upper 4,500s become the next area to watch. And sitting inside that zone is an important resistance area around $4,580. If that gives way as well, then for the first time in this move, $4,600 enters the conversation. Not because 4,600 is guaranteed, it isn't. But because every previous barrier would have been moved underneath the market. Think about how quickly that would change the picture. A few days ago, gold was trading around $4,325. Yesterday, the fight was $4,500. Today, we're asking whether $4,550 can open the path towards $4,600. That is an extraordinary shift, in a very short period of time. But there is still one level underneath the market that matters. Around $4,530, buyers have started building short-term support. If gold pulls back but continues finding demand around that area, the sequence of higher highs and higher lows remains intact. And that's exactly what bulls want to see. Not a market that never falls. That's unrealistic. What they want to see is a market where every pullback gets absorbed at a higher level than the last one. That's how trends sustain themselves. So don't judge this market by whether you see a few red candles. Watch where those red candles stop. That tells us far more. And there is one final test that could tell us whether this week has genuinely changed the gold market. The weekly close. Because this week may end up being about much more than a $200 rally. If gold can finish the week firmly above $4,500, then that former resistance level starts becoming part of a new trading range. That's significant. It would mean the market didn't simply spike above 4,500. It moved above it and stayed there. That is how price acceptance begins. And if the market starts accepting gold above 4,500 on a weekly basis, traders may need to rethink what they consider expensive. So, going into the next session, keep the structure simple. $4,500 has already been reclaimed. The previous high has already been broken. Now the fight moves to $4,550. Break and hold that level, and the market begins looking higher. Push through the upper 4,500s, and $4,600 becomes a very real technical conversation. But underneath all of this, watch how gold behaves. Because that's where the real strength of this move will be tested. Gold has already shown us it can rally more than $200. The most remarkable thing is that after rallying more than $200, gold still doesn't want to come back down. This is Grand Markets. Subscribe for more analysis on gold, US yields, and the macro forces driving global markets. This content is for general information and market analysis only and does not constitute financial advice.